I made some really costly mistakes, and they didn't just cost me money, they cost me time, which is actually even more valuable in investing because time compounds your returns. The truth is, even experienced investors fall into these pitfalls from time to time. So in this video, I'm breaking down 5 common investing mistakes that slows your wealth growth or costs you money, along with facts, figures, and examples to help you avoid them. So if you're new here, you're welcome. My name is Richie, your money coach. And on this channel, I share practical strategies for investing, personal finance, and long-term growth. Mistake number 1, lack of patience. One of the biggest mistakes I see again and again is a lack of patience. This shows up as checking your portfolio every hour, panicking when market drops, selling at the first sign of red. Here is the cold, hard reality. The US stock market, as measured by the S&P 500 index, has returned an average of about 10% annually over the past 95 years, from 1928 to 2022. That includes all the crashes, recessions, wars, crises. But here's the key, that 10% is not smooth. Some years, the market is up by 25%, other years, it drops by 20% or even more. And if you react emotionally, selling on fear, you risk locking in losses and missing the recoveries. For example, from March 2009 to March 2024, the S&P 500 gained well over 400% cumulatively. But in between were multiple drops of 10% to over 20%. That scared many investors into selling. This is why investing legend Warren Buffett says the stock market is a device for transferring money from the impatient to the patient. Patient isn't just a virtue. In investing, it's arguably the most powerful edge you have. So if you feel patience creeping in, remind yourself, time in the market beats timing in the market. The second mistake I see is not investing at all. Stay in cash instead of putting money to work. Many people leave their savings in bank accounts thinking that this keeps them safe. But here is the real problem. Inflation erodes cash buying power over time. According to the US Bureau of Labor Statistics, the cumulative inflation rate from 1970 to 2024 is about 704%, meaning prices are more than 8 times higher today than they were in 1970. To put this in perspective, $1,000 in 1970 would only buy what about $114 buys today in terms of purchasing power. $1 million saved in 1970 would be roughly equivalent to nearly 8.24 million today, just to maintain the same purchasing power. But here's the twist. Stocks over the long-term period have generally outpaced inflation. From 1928 to 2022, the S&P 500 returned roughly 9 to 10% per year, compared with inflation averaging about 3 to 3.5% annually over the same period. This means that while cash loses value over time, investing even modest amounts gives your money a chance to grow faster than inflation. Here is the reality. If you leave your money in cash earning close to 0 to 3% interest, but inflation is 5%, your real return is negative. You will lose purchasing power every year. So the big takeaway, investing is not just for the rich. It's for anyone who wants their money to grow faster than inflation. Even modest investing beats stagnation. This takes us to the third mistake new investors make, which is not having a safety net, meaning no emergency fund before they start investing. According to the US Federal Reserve's 2022 report on the economic well-being of US households, about 54% of Americans said they could cover a $1,000 emergency with savings. 46% said they could not. That means nearly half of the population does not have a basic financial buffer. Here's why this matters. Life is unpredictable. Unexpected expenses happen. Car repairs, medical bills, job loss, and without cash reserve, many people are forced to sell investments at the worst possible times, like during a crash or downturn. Why does this matter for investing? Because if you put all your disposable income into investments without an emergency fund, you risk selling when prices are down, locking in losses. A commonly recommended rule of thumb is to keep 3 to 6 months of living expenses in a liquid, low-risk account before you start investing. If that seems big right now, even starting with a smaller buffer, $500 to $1,000, is better than nothing, because the worst possible scenario is not the market going down. It's being forced to sell investments at a loss because you needed cash. The fourth mistake is investing based on hot tips, hypes, or trends, especially from social media or chat groups. This is one of the most common behavioral traps. Here's the problem. Behavioral finance research shows that social media buzz can drive trading activity, but it often leads to poor performance compared with traditional investing strategies. For example, in 2021, Elon Musk tweeted, "Use Signal," and some traders mistakenly bought shares of Signal Advanced Incorporation, a small company with no connections to the messaging app. The stock briefly skyrocketed, then crashed, hurting many speculative traders. This is not investing, it is speculating. Investing means understanding what you're buying, having a long-term plan, basing decisions on fundamentals, not hype. Think of it this way. If someone online recommends a stock, they might have already taken profits. You might be buying it at the peak. That's how the hype cycle often works. A better approach is focus on diversified investment. Use index funds or broad ETFs. Avoid chasing short-term fads, because the market rewards patience. Informed investors, not gamblers. Now we come to mistake number 5, and this one costs many investors more than any other. People don't realize that taxes are one of the biggest leaks in their investment returns. Taxes come in several forms. Dividend tax, when you receive dividend income. Interest tax, when you earn interest. Capital gain tax, when you sell investments at a profit. A 2024 Morningstar analysis showed that tax drag, that's the importance of taxes on returns, can reduce long-term investment performance by 1 to 2% annually if you're not using a tax-efficient account. That might not sound like a lot, right? But over 20 to 30 years, that compound erosion can turn a good investment into a mediocre one. For example, if an investment returns 7% annually before tax, and tax tracks it down to 5% after tax, over 30 years, that difference in your final portfolio value can be hundreds of thousands of pounds. Let's look at tax brackets in the US. Short-term capital gains, taxed at ordinary income tax rate, up to 37%. Long-term capital gains, taxed lower, 0 to 20%, depending on income level. In the UK, capital gain tax on investment can be up to 18 to 28%, depending on the asset and income band, and dividends are taxed separately. Now, when you combine taxes with investing costs, fees, inflation, and emotional mistakes, the average investor can easily underperform simple, tax-efficient strategies by a significant margin. Good news, there are legal and reliable ways to reduce taxes in the UK. Stocks and shares individual savings account (ISA), all gains and dividends are tax-free. Pension allowances, tax relief on contributions in the US. Roth IRA, tax-free growth. 401k, tax-deferred growth using tax-efficient accounts can dramatically improve your long-term results because your gains stay invested instead of being taken out by tax. So now you know the top 5 mistakes: lack of patience, not investing at all, no emergency fund, following hype, ignoring taxes. But the lesson underneath all of this is simple. Investing is not about returns, it's about systems and habits. Consistent investing, learning how markets work, using tax-efficient structures, and choosing strategies that fit your goals and risk tolerance. Rich people don't just get rich by timing the market. They get rich from discipline, consistency, long-term thinking, and smart tax planning. So if you're a complete beginner, are you feeling doubted on how to start? Drop the word growth in the comment section and I will do a video where I'll be explaining how to start with little as $500 to $1,000. Guys, if you've got value from this video, please do well to subscribe, like, share, and drop a comment. This helps the channel to grow. Till then, see you in the next clip. Cheers, guys.